first of all, I see a lot of familiar places or faces, people I've known for many, many years. And it's great to see you. I mean, this is telling me what it tells me today, and I roll back a year or so, that when people think about the power semiconductor market and where it's transitioning and where it's going, it's not some of the old legacy companies, right? I think it's about us. I mean, we are, from a technology standpoint, from a product standpoint, from a focus standpoint, I think we check all those boxes to really win in this market. And when someone, and I've known a lot of you, and some of you may have asked me, I joined here middle of 22, and they asked, well, why Navitas? And we've all had a chance to sit here and listen to Gene and Dan and Jason and Hal and Dave, and I think it's pretty obvious why. I mean, we are positioned to drive some significant growth and really drive this market forward. So what I think I'll do is, not what I think, I'm going to go over 23. We've talked a little about 23, but I'm going to look back at 23 and then go forward. We'll roll it forward, talk about how we see gross margins rolling out, a long-term model, how we're going to invest, where we're going to allocate capital, and so on. So let me just jump in. So if we go back to the beginning of the year of 23, and you think about, what were we saying then, almost 12 months ago? And we went out and said, look, we think revenue is going to more than double this year. And in a tough macro, tough environment for semiconductors, we're more than doubling this year. We talked about our gross margins expanding throughout the year, and they've done. Each quarter they're up incrementally, and in our Q4 guidance, we've indicated they'll continue to expand next year. OpEx, we've been investing, and clearly investing for growth, and we will continue to do so. But we've consistently talked about, look, you will start to see leverage in our business on the OpEx, and that's what you're seeing now. So OpEx as a percent of revenue is declining significantly. Working capital, we want to be really, really efficient. I mean, people trust us with their capital. They've invested a lot of money in us, and we want to be super efficient with how we manage capital and manage our balance sheet. Just a couple things to look at there. Our inventory turns are up over 3 times. And our cash conversion cycle, which we really focus on, is down by almost half in the last year. So we're making tremendous progress on the balance sheet and working capital. And look, at the end of the day, what it comes down to, are we delivering returns to our shareholders that are in excess of our competitors, our peers, the indexes, and so on? And I think we're doing that this year. Wrong button. So let me just talk about revenue and break it down. I think you see the annual revenue. Gene pointed out, look, we're winning awards from Deloitte and Forbes about the fastest growing companies and being on those lists. And then if you look back at this year, though, and you look at the growth and how it's rolled out, a few things are happening I'd like to point out. So we did acquire GaNSafe in Q3. So Q4 of last year is the first full quarter with GaNSafe. And so the doubling continues, Q4 this year on our guide to last year. But what's really driving it? I mean, it's consistently up every quarter, and we're seeing margins going up every quarter. So what is driving that? What sits behind this, and how does that relate to the business going forward? So there are a number of things driving it. One, and Dave talked about it, we've talked about it, is, look, our end markets are diversifying. It's 2 years ago, it was 100% mobile, and it is not that today. Mobile's becoming an important but smaller percentage of the overall business. Dave touched on it. GaN is here. It is a displacement technology, as is silicon carbide, and we're seeing that, and we're seeing it today. And I think for those of you who listened to our call at the end of Q3, I think our commentary on the market, and the mobile market in particular, may have surprised some people. And I think part of that is, look, we're a leader, and what others see doesn't mean that's what we see, right? So I think we want to be that first call when people pick up the phone and say, Gene, what are you seeing in the market today? Because again, I think from a leadership position, we're seeing things, like I said, that our competitors might not be seeing. We've talked about other markets. Our first onboard charger that started ramping this quarter, so that's helping drive growth. And And when we step back and we think about, well, what's another fundamental difference between us and our competitors? And I've mentioned this to some people, and I came here and I saw the investment in the system design centers. And I've been in the business for a while, and it's a home run. It really is. It's a much, much different way of working with customers. It's not something I've seen in my career, and there was a lot of investment there. And I think a lot of that is, look, GaN was a new technology. How do you drive it to market? And what we're seeing today is the results of those efforts. And it's not a chip design center. It's truly a system design center. I think that's very important. And so when we go to market and we engage with customers, it's an acceleration of that engagement. It really is. And so those are paying off, and they'll continue to pay off. And I think absent that, we will grow much faster than we otherwise would have. So diversification. So this is important, right? 2 years ago, we were 100% mobile. It's a great market for us. It's a big market. But I think you think about it, and it's characterized by ups and downs, a little more volatile. I think it's better for us, better for you, to see a little more predictability, a little more diversification. So you can see where we ended up, estimated to end up this year in terms of market mix in our revenue. It's less than half mobile. So even though mobile has had some strength and does have strength right now, it's still less than half the revenue. And going forward, when you look at the pipeline, it's less than 20% of our opportunities today. So Dave touched on appliance and industrial. I mean, that turned out to be our fastest growing part of the pipeline. And as a CFO, those are the best markets out there. They're a little longer to design in. They're a little longer to adopt a new technology. But once you're in, you're in. And those programs can run 5 or 10 years. And so you'll see us, as we go forward over the next few years, you'll see this transition in our business. And again, we're displacing silicon technology. And once we do that, and based on the technology we have, these are the things that will drive margins higher. So gross margins. We guided 42.5 at the midpoint this quarter. And our view is, as we develop a long-term model, we look out, I mean, it's important. I think there are premium valuations, right, for margins above 50%. And we're very focused on it. When you think about our margin expansion and how that rolls out, there are really 3 buckets to think about for us. One is strategic manufacturing investments. So we made an investment, and we discussed it earlier this year, tied around our financing. So we're making an investment in EPI, which will go right down here under us. That's a $20 million investment. So that's the first of what you would think about in terms of strategic manufacturing. I mean, that enables capacity, certainty of supply, lower costs, faster learning cycles. So that's the first step. There will likely be other opportunities on the manufacturing side to further drive costs. End markets we talked about. The more end markets become diversified, and in those end markets, they generally have higher margins, right? And that'll help drive margin. And then lastly, and I think very important is is continuing to push our technology advantage. I think you've heard from Dan, you've heard from Sid. I think it's pretty clear. I mean, we're not just saying it. The data says it. We're able to present data that says, look, what we're doing is better than what others are doing. As we continue to push that edge and push that envelope, our customers, will look at that and they'll pay us for that. And there is value in that. And that's a key factor in keeping us ahead of our competition. So the net is, look, we're 42.5 right now, and the focus, and when we look at these areas, is to drive them north of 50%. Operating leverage, I touched on this a little earlier. We're seeing it today. I think we've been consistent over the last 4 or 6 quarters about communicating to the market, communicating to you, look, you will start to see leverage in the business. And that's exactly what's happening today. I think our Q4 guide, OpEx is up less than 20% year over year, but revenues are 100% up. So you're seeing that, and it's happening, and it's going through the P&L today. I think going forward, the way to think about it is, look, investment in R&D, investment in SG&A will continue to grow, obviously, in absolute dollars, but as a percent of overall revenue, it'll come down. I mean, revenues will grow much, much more quickly than OpEx. But again, the focus is we will continue to invest, in particular, those areas that will drive growth. We are very focused on growth, and we're very focused on the P&L too. So I think the leverage in the business, the investments we've made to date, are starting to flow through the P&L. So a long-term model, revenue. So what do we look at in terms of revenue? How do we look at the market, and where do we think we sit within that? So, we think we can grow, and we look at a model 6 to 10 times the market growth rate. And the way we characterize market is the power semiconductor market. And again, that's the market we're addressing, right? And that's the market, it's a $22 billion market in 3 or 4 years. It's transitioning to silicon carbide and GaN. Even if that market's relatively slow growing, we're going to grow significantly faster than that. That's what you're seeing today, right? You see it in the mobile market. Our growth tied to that market was significantly higher than the overall market growth rate in the mobile market. Okay? And so that's what we're seeing going forward. So 6 to 10x the market growth rates. And again, what's driving that? It's pipeline. It's growing, more diversified, so that'll drive growth. And again, it's extending our leadership, right, in GaN. I think that's unquestioned that we're the leader in GaN. And then silicon carbide. We've been in the silicon carbide business for 1 year, right? And we will take share. I mean, we will, from here going forward, we will take share. We have superior products and technology, as Sid walked through. And that's happening, and we're seeing that today. Gross margins, we talked about it a little bit. It's multiple categories. It's markets, it's products, it's technology. These are all individually and collectively factors that'll drive margin expansion, and strategic manufacturing. We will make investments. We will be prudent, obviously, with our capital, but we will look for accretive investments in manufacturing that will drive margins, drive revenue. In OpEx, we will invest for growth. We are not creating leverage or OpEx as a smaller percent of overall revenue by cutting or holding things flat. We will continue to invest, and we will invest for growth. So you will see the spend go higher, but as an overall percent of revenue, it will come down. And so longer term operating margins, the today is north of 20%. So we want a strong operating model. We want premium gross margins, premium growth rates, which I think is where we're heading and what we're demonstrating today. We want OpEx that is, again, very targeted. We'll focus on growth. I think we're efficient in SG&A, and that'll generate superior operating margins. And then investment and capital allocation. So you collectively and others have trusted us with capital, and a lot of capital, and it's up to us to deploy it in a way that generates the biggest return for you. So where do we do that? We're committed to R&D, innovation, and growth, right? We have leads in GaN, and we have leads in silicon carbide. We do not intend, to not maintain that advantage. I mean, we're going to continue to focus that and invest in it. Again, accelerating investments, we will continue to put money into R&D. So this is in no way a story about, they're not going to invest. No, we will invest. And operating leverage, we've talked about that. So invest, revenue growth, OpEx as a percent of revenue will come down. As strategic manufacturing, look, we are capital efficient, call us capital light. we've made the investment, or we're making the investment in in-house epi. And we will make similar investments. We won't hesitate to make those investments. That again, it's certainty of supply, it's learning cycles, it's yields, it's costs, and all that feeds into our margin profile. M&A, we've stated M&A is part of the strategy, right? I mean, we're not shying away from that. We've done 3 acquisitions over the last year or so, right? And we will focus, and we'll continue to focus. We see opportunities. We look at opportunities, that are accretive to the business. So when we come to you, and if we do one, and say, here's why we did it, it'll make sense, all right? We're not here to necessarily acquire technology for technology's sake. I mean, it has to be complementary. And again, it has to drive growth and be accretive. The balance sheet, we have a really good balance sheet. We have more than $170 million in cash, no debt today. So the balance sheet's in a great position, to fund the organic business and that long-term model that we were talking about. It's there, it's today. We don't need to raise money to fund that business. So we get the question, and the only reason we would go to the capital markets would be transaction related. We do not need to approach the markets right now. And shareholder returns, I think that one's pretty obvious, right? It's, we want to generate returns for you, our shareholders, that are well in excess of relevant indexes or our peers. And we've done that this year. So that's all I have.